This is KOCI LPFM 101.5, Newport Beach, Costa Mesa. Good morning, Orange County. It is 10 o'clock, which means it's time again for the Money Matters program. This is Troy Davis, your host. You can reach me at troydavis.com, or you can send me an email anytime at troy@troydavis.com if you have questions about today's program or anything going on with our economy. Well, what I want to do this morning is put together what might be the best and most accurate information regarding home prices and our economic recovery. And to help me with that, I have on phone from Arizona the Vice President of Statistical and Economic Modeling with Veros Real Estate Solutions, Mr. Eric Fox. Good morning, Eric.
Hi, Troy. Thanks for having me this morning.
Now, I'm glad you're here. I understand it's even warmer in Arizona than it is here, huh?
A little bit, maybe 100 degrees for us today, so you guys have got the cooler weather.
Yeah, well, at 90, we'll take cool at the ocean here. So, Eric, you and your company put together a statistical model, a forecast for not just Orange County and California where we are, but the nation as a whole. Tell us a little bit about the forecast that you folks put together.
Well, our forecast actually looks at the nation as a whole, as you mentioned. We look at the majority of the metropolitan areas in the country. We have roughly 325 of those metro areas. We actually look at zip code level as well, and we look at various counties, almost 1,000 counties around the country. We also take a look at differences in the price tiers. We recognize that an entry-level home has a different possibility for appreciation or depreciation than, say, a very high-end home. Likewise, we separate out the differences between condos and single-family residences. So that all sort of goes into the building blocks of our product. And then from that, once each quarter, we update that forecast. And as a matter of fact, we just updated that forecast late this past week. So the numbers that I have here this morning are about as up-to-date as they can possibly be.
You know, and I share that with my clients as well on a much smaller level, obviously, but I always tell them, get all the possible information you can, so at least any decision you're making is an informed and an intelligent decision. And I think what you bring to the table is just that. Here's the data that you need. Now, who uses the data that you put together?
Well, we have a lot of different providers that use the data. Anybody that has a decision that they need to make, underwriting a loan, carrying portfolios of loans, investors use our product. So lots of different folks in the entire space use our product, and it really gives people a way to make informed decisions whether or not they want to fund a loan, whether they want of a certain type. The other interesting thing, as I mentioned, is we can't just simply say one part of the country is good and one part of the country is bad. It's not that simple. It might be a relatively bad part of the country is pretty good in the entry-level single-family market, as an example. So they would want to make a decision that, yes, we can fund that segment of the market, but maybe we don't want to fund more expensive homes in that type of environment.
Yeah, and I think that's part of what makes many of our people looking to buy a piece of property stop and question it. Number one, they're looking at the economy in a whole going, why would I buy right now? And I've got answers to that, and I'm sure you do as well. But like you said, there's different parts of the country that are doing different things, and if you want to break it down into a microcosm, you can go neighborhood by neighborhood right here in Orange County. I mean, there's certain parts of Newport that are depreciating. There's certain parts that are appreciating. It just depends on location, amenities, and all those sorts of things. And I think that ties in with the variables that you use. What are some of the variables that you put into your forecast?
Well, there's several. There's the macroeconomic variables, as you would expect, things like unemployment rates, interest rates, inflation, population trends in an environment. For example, in Orange County, there's generally a net influx of folks, whereas you look at some markets, say in the Midwest, there's a general exodus of population. So that's a very important variable. We also look at seasonality. Some markets are definite seasonal markets. For example, someplace like Chicago has the classic wave that peaks in the summer and dips in the winter. You look at some place like South Florida where the snowbirds come in every year, just the opposite. Other markets like Southern California, it's sort of a mix. There's not that seasonal as much, but there's a little bit of that, so we look at that. Another key variable, of course, is the supply of homes on the market. Even if economic macro fundamentals are in great shape, if a market has 20-month supply of homes on the market, it's not going to recover next week. We look at amount of buildable land. Certain markets like a San Francisco or a Seattle that really have no more available buildable land in the core metro areas perform very differently under the same economic fundamentals than, say, a Dallas, Texas, or an Indianapolis, Indiana, where essentially they've got farmland in all directions around the metropolitan area. We look at things like the affordability index, so how affordable is that particular market relative to the incomes in that area. We look at things like what percentage of the mortgages are being originated with very high loan-to-values. That gives us an indication of how stretched borrowers are in that market. Obviously, the more stretched they are, the more difficult it is for pricing to go up. And many other variables are just a little bit of a sampling some of the things that we use. But it definitely is an extensive model, not just a simple correlation with unemployment and pricing. You can't do things that simply and expect to get a good result.
Yeah, I mean, that'll give you a chart you can look at, but it's certainly not the detail that you were looking for to really make decisions.
That's correct.
And you actually mentioned, time on market. I think right now we've got almost 4 million homes on the market nationwide. And if nobody else listed their home and all the banks stopped putting foreclosures on the market, in other words, nothing new came on the market, it would take almost a year to get rid of that inventory right now. That's quite a long time.
That is a long time. And historically, when we're in a balance situation, as I'm sure you're very familiar with, we want to be at 5 or 6 or 7 months of supply of homes.
I'll take
so now
two,
the US
actually.
As a whole,
since I'm in the business, I'll take it. 1 or 2 will be fine with me.
Yeah. So that's why we can't have a real favorable outlook if, on average, in the U.S. we have about a year's supply of homes. But that's broken down into some markets that are doing very well, that have much lower supply of homes, and some markets that are doing far worse than that have far more supply of homes than that.
Well, speaking of that, we've got, like you said, you've got a lot of areas that are doing well and others that are not, and you forecast those out. Let's take a look, first of all, on some areas that are our strongest markets across the nation. What are you seeing as being a strong market right now somewhere in the nation?
Well, strong across the nation for the forecast for the next year would be markets. A lot of the major markets in Texas expected to do very well. Houston is our top forecast performing market. Again, these are numbers that just were released this past week. Is forecast to go up at roughly 4% between now and a year from now. Dallas is close behind at 3%. Amarillo, Texas, also at 3%. As a matter of fact, 4 of our top 10 markets are from the state of Texas. In addition to Texas, generally the Central Plains area is forecast to do quite well. Louisiana, Missouri, Iowa, Arkansas, Oklahoma, Nebraska, the Dakotas, that whole general corridor is an area that should see some pretty good appreciation, certainly nothing like the heydays of 2006 or 2005 where we were seeing 25% in some parts of the country.
Right.
But these days, I think anything greater than 0 raises some eyebrows as a good performing market.
And what are you looking at those, like 3-4%?
Yeah, mostly all of our top performing markets are in the 3 to 4% range.
Okay. And what is it about Texas that is making people want to stand up and take a look at that?
Well, Texas really has 2 things. One, it did not really participate in the run-up that the coastal markets did, the Floridas, the Arizonas, the Californias, and so forth. So they really haven't been propped up and have a lot of way to fall. They just never went up. But the second big thing about those is that the economic conditions there are quite good. So instead of having a 10% unemployment rate like we do on average in the nation, Dallas or Houston's unemployment rate's running around 5 or 6%. So I think what happens there, buyers are saying, well, our economy's pretty good here. I feel pretty comfortable. Interest rates are at all-time lows. Affordability is reasonable like it's always been. I don't have any problem going out and buying a home. And when you've got a group of folks doing that, prices go up very modestly year over year, and that's really what's happening in Texas.
Can you tell me what it is what's the big employment base there? Is it still oil?
Well, there's oil. it's different, of course, but Dallas is a bit different than Houston. But
Sure.
Houston, clearly, a lot of oil. Austin is going to be a lot of the high tech. San Antonio, a lot of government work. Dallas is a mix of many things, but there's just a general, the environment there is just quite good from an employment point of view.
And you also mentioned Louisiana, areas like Shreveport, Louisiana, and areas like that. Does that have anything to do with what's going on in the Gulf down there? Because the prices did get so depressed, and the government went in there and gave a lot of government aid to put housing back together. Did that have an impact on that?
I'm not sure specifically on Shreveport what's driving their good economy and low unemployment rates, but that general area, I think, is helped by oil. Oil right now, pricing is pretty good. Even though it's not at the highs it was a year or so ago, it's still pretty good.
And then you look at, I'm wondering how you can build into your model something like, we're talking about Louisiana, and certainly we had this big disaster down there with the BP oil spill. If that comes into your equation, and if it does, how also did perhaps Katrina come into your models at that time? I mean, do you have to factor that in?
Well, that's a very tough thing you mentioned, exogenous events,
right.
How you factor those in, because those are essentially events that are one time. They happen. You probably never thought they were going to happen. No way you could forecast that they would happen. And it's interesting you mentioned Katrina, because there's a temptation to say, well, Katrina is going to come in, hit New Orleans, and therefore prices are going to plummet. And you need to factor that in. Well, that's absolutely what happened. However, at the beginning of Katrina, right after it happened, it wasn't really clear what was going to happen to housing in New Orleans, which was primarily where it hit. And if you go back to the early 90s when Hurricane Andrew hit South Florida, something completely different happened there. When Andrew hit South Florida, the supply of housing plummeted. Everybody stayed there, wanted to live there, no place to live, so prices went way up. Katrina, just the opposite happened. Mm-hmm. It hit, everybody left New Orleans, prices plummeted. So two exogenous events that were essentially the same, a hurricane, and two completely different outcomes. Oftentimes, the other thing I caution against with exogenous events is the opposite thing happens from what you think might happen. I mean, 9/11 is a perfect
That's a good point, yeah.
Everybody thought prices in New York were going to plummet. Just the opposite happened.
Yeah.
So we certainly take a look at those insofar as how they impact unemployment, how they're going to impact inflation, different things that are going to feed our models, but we don't really put in a BP oil variable or a hurricane factor in a market once it happens.
Well, you're breaking out your crystal ball again, and that's what everybody fears is, that's not really the way to make a model. We are speaking with Eric Fox with Veros Real Estate Solutions from Arizona via telephone. Now, Eric, you're widely quoted, in fact, just as early as yesterday in the Wall Street Journal. In one particular place, you said more coastal California markets are showing signs of improvement, and you have San Diego, Carlsbad, and San Marcos on your strongest market list. What's going on there?
Yeah, the interesting thing was, and early on in the decline, San Diego was really the first city to participate in the decline. In fact, when Orange County was very strong back in 2006, early 2007, San Diego was showing signs of starting to go down, and I started to question what was going on there, and sure enough, it went down. I think what's happened is they corrected earlier. Pricing and affordability got down more quickly there than, say, Orange County, Los Angeles County. And so as a result, they're down at an area now where the pricing is so good, people are coming in and starting to buy again, which is eating up supply. So I think that's really what we're seeing in San Diego County that's a bit different from what we're seeing in Orange County.
And from my standpoint, my perspective, I see typically that investors jump into those markets first. Are you seeing that as well?
Yeah, that's exactly what we're seeing. I know that it seems like whenever investors can get a return of 7, 8, 9, 10%, that's when they start jumping in. Mm-hmm. And now in lots of Southern California markets, we're seeing affordabilities back at the levels that they were in 1999, 2000, 2001, with a combination of low prices, low interest rates, and so forth. If an investor can pay cash for a property, there are a lot of markets where that investor can, after paying the fees for homeowners associations or maintenance or whatever they need to pay for, with the rent they're commanding, which is quite good now, they can earn 8-10%, and that's pretty hard to resist. So those investors are essentially putting a floor in a lot of different markets where pricing has gotten to that level. We tend to see that in the entry-level properties, sort of by definition, I guess, which is what a floor is, because the rents in the entry-level are generally able to pay for that investment versus the high-end, the rent for a house that costs 3 times more, the rent's generally not.
Yeah, there was that, plus all of the federal stimulus programs and everything else that helped so many first-time buyers get involved. Of course, those programs are pretty much dried up now, and California's is as well. But that certainly put a peak in the bell curve.
Correct. That's correct.
Now let's talk a little bit about the markets that are weakest and, in fact, still depreciating, if you will. What are you seeing there?
Well, I think one word, Florida, and definitely have some friends I told about the show this morning that are listening from Florida.
Welcome, everybody from Florida.
But 6 of our bottom 10 markets for the next 12 months are forecast to be in Florida. Port St. Lucie, which is on the southeast coast of Florida, just a little bit north of the West Palm area, forecast to be down a little over 7% in the next 12 months. Orlando, about 6.5%. Daytona, Sarasota, some of those markets also in the negative 6% range. Also, we're seeing continued weakness for Nevada, Las Vegas, and Reno. Very different types of markets there. Unemployment in Las Vegas, for example, running at 15% right now. Supply of homes in the Las Vegas market is very high. So that just doesn't allow conditions that are going to be conducive to appreciation for quite some time in that area. So
Eric,
those particular areas not looking too good. Idaho, Utah, Washington State not looking so good. A lot of those markets actually were fairly late to the game as well. Seattle was one of those holdout markets when all the other major markets were falling. Seattle had another double-digit appreciation year a few years back, so I think they're just lagging behind. And then interior California, not a little bit better, but not doing forecast to do too well. So those would be markets like Fresno, Modesto, Bakersfield, and so forth.
And Eric, as I'm trying to track what you're saying, I'm looking at areas like you were talking about in Nevada, Vegas certainly, when they had that enormous build boom about, 7 years ago, 5 to 10 years ago? They just built too much, it seems, and a lot of people bought those and they got upside down. Well, the same thing happened in the Inland Empire area here with Riverside, Corona, etc., but yet those areas you're predicting an increase, yet these ones in Arizona a decrease. What's the difference?
Well, I think the Inland Empire, Riverside, San Bernardino, for example, they have corrected so much. Affordability levels there are back into the mid to late 90s levels. And also the big advantage that the Inland Empire has, say, over Las Vegas, is Inland Empire has proximity to jobs and a very large population. Vegas is basically a much smaller metropolitan area, a single industry, basically a service hotel industry, and in recession, service hotel industry is hit very hard. So I think the access to jobs in the Inland Empire really, in combination with the vastly improved affordability, allows that type of market to go up, where Vegas really has to have everything hitting on all cylinders because they've got limited upside potential until everything's back.
And then shifting back to your buddies in Florida that are listening, I mean, you've got a beautiful state. You've got miles and miles and miles of coastline, intercoastal. Seems like it'd be a pretty hot spot. Why in the heck has that been so depressed for so long?
Well, I mean, it also came up quite aggressively. When you look at some of the markets in the country that appreciated the most, Florida was one, believe it or not. And I think part of the other reason is Florida had been so flat for many, many years. I mean, I lived in Florida back from the late 80s to early 2000, and in that entire time, my house there, I think, appreciated 30%. So that market had just been very flat, and then all of a sudden, 3-4 years, prices there tripled, and it was a big increase. So they had a long way to fall. You look back in some place like Southern California, they're sort of used to that kind of environment, and so they didn't triple. And so that's why I think Florida continues to be hit. And until the supply gets absorbed, that's really one of the key variables. I mean, especially in Miami-Dade County, we're looking at the condo market, still extremely large supply, much overbuilding. I mean, 20 20 months supply there. That market just can't turn around overnight because of that.
Yeah, and when you're looking at the downturn in values, I mean, a lot of economists say we're going to lose 2, maybe 3% over the next, 12 months or so. I look at that and go, it doesn't seem that bad. But when you're sitting on your house and your loan may be the same value as the property itself, it is bad. But if you're looking at a $500,000 house and it goes down 2.5%, it's about $11,000. You're now at $489. It doesn't seem that bad. But when you take it in a larger picture, that is a big reduction in values across the nation.
Oh, it really is, and I think people now maybe are a little bit lulled into thinking, hey, that's not so bad anymore because we've had minus 10%, minus 20%, and so minus 2 or 3, that's great. As a matter of fact, if we look at our current forecast for the nation as a whole, we're forecasting for the top 100 markets around the country between now and 12 months from now that the average price change will be a minus 1.3%, so a 1.3% depreciation on average. If we break that down among the markets, there are approximately 2/3 of the markets that we're forecasting to depreciate in the next 12 months, and 1/3 of the markets that we're expecting to appreciate. The good news with that is if we back up just a quarter and go back to June of 2010, that number was minus 1.9%. So we're seeing things gradually get a little bit better. The outlook look a little bit better for the next 12 months, and just in the past 3 months, we're seeing that move in a positive direction. But still, overall, we're seeing negative, albeit very slight.
Yeah, and I ask many of my guests here on the program as a kind of a closing question, which I'm not quite ready with that with you yet. But what do you see from your industry, your perspective, where we're looking at in the economy? And they all say the same thing, which is what you're saying as well, I believe, and that is there are positive indicators. Things are looking better in a lot of segments, but until we can get the housing thing squared away, until we get people back to work, it's going to be a very long, slow crawl out of this economy.
It is going to be that, and I like to think about it as a giant map of the United States where some of the counties are colored green and some are colored red, and we've got about 1/3 of the counties colored green right now, and each month that goes by, a few more of the red ones turn green, but it's gradual, and it's going to be very slow, and certain things are going to happen for some counties to turn from green to green from red than other counties. The economy is going to have to be firing on all cylinders for Las Vegas and Clark County to turn to green. Some other counties are very, very close to turning to green. Maricopa County, Arizona, for example. Mm-hmm. So there's a lot of things that I think we're going to continue to see improvement, but it's going to be very slow. Other comment I'll make is that when we look in the 1 to 2 year horizon, and that's the extent that our forecasts go, we're seeing right at a flat or 0% appreciation. And at that point, we are at roughly 50% of the markets appreciating, 50% of the markets depreciating. So we do see a continuation of things improving, but slowly.
Yeah, and I like to use a football analogy. It seems like we're back to a market. Earlier in the spring, we here in Orange County, we certainly saw an uptick in sales, again, partly due to the first-time homebuyer credit, although where I'm sitting right here in Newport Beach, that doesn't fit in real well because the prices are much higher and it's a little difficult sometimes for the first-time buyers, nor did some of them fit the program. But using the football analogy, it seems like we've got one sideline with buyers, the other sideline with sellers, and nobody seems to want to come to the field and play. Sellers are still saying, well, I'm going to hold out. I think my value is there. And buyers are like, no, it's not. So until everybody gets on that field, we're going to kind of maintain this. And what's the answer? Some of these pundits are saying, just slash your prices. There's a buyer for your house at the right price. Is that kind of what you're saying?
Yeah, I think so. In some markets, that's happening because of high foreclosures and short sales, and so banks are doing the price slashing for that market. In other markets where that's not a big percentage of the market, you're right. We're sort of in a stalemate, and people are just staying on the sidelines. So eventually, all markets will get to equilibrium however they get there. Yeah. But I think your analogy is a good one.
And in the meantime, too, we still have that large, what I've referred to many times on the program here, and that's our shadow inventory, which is all those properties that the banks either are holding now or will be holding as soon as a few more defaults happen, and they will. It's unfortunate, but that's reality. And they're saying now there could be 4 to 5 million potential foreclosures coming up, which is going to put a significant downward pressure on home prices. And, there's already about 11 million home owners that are underwater. And I think the stat is if it's another 2.5 million people would join those with just a 5% depreciation.
That's true. The only thing I would caution there is that when you look at the comment we made with investors a little bit earlier, primarily the homes that are in that pool are entry-level homes, and if the affordability is already at a good level, as soon as those go on the market at aggressive pricing, investors are going to swoop in and get them. So we have to be careful about saying that an increase in inventory by X amount today is going to have the same influence on prices as that same increase in inventory, say, a year ago would have.
Yeah, that's a great point. And I tell a lot of my clients, and I've always been a pundit, that you don't know when you've hit the bottom of the market until it's already on its way back up. Because people say, well, I'm going to buy at the bottom. Well, good luck pointing that out. Let me know when that is, because I'll buy too. But it's kind of hard to pinpoint that. As a parting question, we're running out of time, Eric, but as a parting question, are we going to gap up again, or is this our new normal market?
I don't think it's the new normal. Real estate's a scarce resource. Supply and demand dictates we're going to have bubbles, peaks, and valleys. So what's going to happen all of a sudden, especially in Southern California, one day everybody's going to wake up, say, hey, things look pretty good. I'm comfortable. The economy's moving. Interest rates are still pretty low. I've got my job for a while. Let's go out and buy our house since the prices are real good, and all of a sudden we'll see a price gap of 10%.
Right.
And we'll forget all about this. So that's happened historically many, many times in Southern California. I think it's going to happen again, but I think it's going to be a slow process to get there.
Well, your predictive technology is a great resource for our financial industry, your risk evaluation with Veros Real Estate. We're speaking with the Vice President of Statistical and Economic Modeling, Eric Fox with Veros Real Estate. Eric, thank you so much for putting a bigger picture perspective on this. It was very helpful, and I really appreciate you being on the program this morning.
All right, Troy. Well, thank you for inviting me.
You're very welcome. Well, I hope to have you on again.
All right.
Thanks. Bye-bye. All right, this is KOCI LPFM 101.5 Newport Beach, Costa Mesa. This is the Money Matters program. I'm Troy Davis, your host. If you have questions about today's program or even some questions from Eric that I can pass along to him, you can shoot me an email at troy@troydavis.com. If you have real estate questions or you want to find out a lot of stats anywhere here in Orange County, you can go to my website, which is troydavis.com, and you can find out all sorts of information there, including the multiple listing service and stats on every neighborhood in Orange County. And again, this is KOCI. Thank you so much for listening today. I certainly do appreciate it, and you all have a great weekend.